Gold and silver just crashed. And I know you are watching the charts right now with that sinking feeling in your stomach. I know some of you woke up this morning, checked your positions, and felt your heart drop. Gold falling from above 5,100 to 49.57. Silver dropping from above 82 to 76.95. Red candles everywhere. Your portfolio bleeding. And I need you to stop right now. Stop panicking. Stop checking your phone every 5 minutes. Stop thinking about selling everything. Because what happened today, February 12th, 2026, is not a disaster. It is not the end of the bull market. It is not proof that you made a mistake. What happened today is exactly how markets work. And if you understand what I am about to show you, this day will not scare you. This day will educate you. This day will make you a better investor, because I have seen this exact pattern hundreds of times in my career, and every single time the people who panicked lost money. The people who understood the mechanism made fortunes. Welcome to the hidden economy. If you are new here, I cut through the noise and show you what is actually happening in markets, while everyone else is distracted by fear and headlines. I do not do hype. I do not do hopium, and I definitely do not panic when markets do exactly what markets are designed to do. Subscribe right now, because this is the kind of analysis that separates successful investors from the crowd that always buys high and sells low. And if this video helps you understand what just happened, smash that like button. It tells the algorithm that education matters more than fear. Now let me explain exactly what happened today, because once you see it, you will never be fooled by this pattern again. Look at the charts I am showing you. The first chart is silver. You can see it dropped from above $82 down to 76.95, a significant move. The second chart is gold. It fell from above 5,100 to 49.57. Both metals moving together, both making dramatic drops, both creating fear in the hearts of investors who do not understand what they are looking at. But here's what I need you to see. Look at the price action from January 26th, 2026 until today. What do you notice? Both gold and silver have been building something. They have been accumulating, slowly grinding higher, making higher lows, creating what traders call liquidity. And that liquidity is the key to understanding everything that happened today. Let me explain liquidity in a way that anyone can understand, because this concept is absolutely critical. Imagine you want to sell your house, but there are no buyers. You could have the best house in the neighborhood, but if nobody wants to buy it, you cannot sell it. Now imagine the opposite. Hundreds of buyers all wanting your house, bidding against each other, driving the price up. That is liquidity. Buyers ready to buy, sellers ready to sell. Activity and interest concentrated in one area. In financial markets, liquidity works the same way. When lots of people place buy orders at certain price levels, they create liquidity pools. These pools are where the big players, the institutions, the hedge funds, the whales, they need these pools to execute their massive orders. Think about it. If JP Morgan wants to sell $500 million worth of gold, they cannot just click sell on their computer. That would crash the market instantly. They need buyers. Lots of buyers. They need liquidity. So what do? They wait. They wait for retail traders like you and me to pile in to buy positions. They wait for FOMO to build. They wait for everyone to become convinced that the price is going straight up. And then when enough buyers have accumulated, when enough liquidity exists, they strike. That is exactly what happened from January 26th until today. Let me walk you through it step by step. On January 26th, gold was recovering from the previous crash. Silver was bouncing back. Retail traders saw the recovery and started buying. They thought, this is it. This is the bottom. Time to get in before it goes back to the highs. Every day from January 26th onward, more buyers entered. More people placed buy orders. More liquidity accumulated. The price kept grinding higher, which attracted even more buyers. People who had been sitting on the sidelines said, okay, it is going up. I do not want to miss it. They bought. People who sold during the crash said, maybe I sold too early. Let me get back in. They bought. People who heard from their friends or saw YouTube videos saying silver is going to $300 said, I need to get in now. They bought. And all of those buyers, every single one of them, they placed stop losses, because that is what they were taught to do. Protect yourself. Limit your downside. Place a stop loss just below the recent low. Sounds smart, right? That is what every trading course teaches. That is what every financial advisor recommends. That is what seems logical. But here is what those courses do not tell you. When everyone places their stop loss in the same area, they create a target. They create a pool of liquidity that the big players can see, and they create the exact mechanism for their own destruction. Let me show you exactly how this works using the charts you are looking at. From January 26th to February 11th, silver ground higher from the lows around 77 up to above 86. Every time it pulled back slightly and then continued higher, more buyers entered. Each pullback was bought, each rally attracted new money, and each buyer placed a stop loss somewhere below. Some placed tight stops, maybe 2% below their entry. Some placed wider stops, maybe 5% below. But the clustering effect meant that there was a massive concentration of stop losses in certain zones. The algorithms that the big institutions use, they can see this. They can see where the liquidity pools are building. They can see exactly where the retail crowd has placed their protection. And they can calculate exactly how much profit they will make if they push the price through those stops. Now let me tell you what a stop loss actually is from the market's perspective. When you place a buy order and set a stop loss below it, you are essentially saying if the price drops to this level, sell my position automatically. That sell order does not exist until the price reaches your stop. But once it does, your stop loss becomes a market sell order. And here's the critical part. If thousands of traders have their stops in the same zone, what happens when price reaches that zone? Thousands of automatic sell orders hit the market simultaneously. That creates a cascade, a waterfall of selling. Price drops faster, which triggers more stops slightly lower, which creates more selling, which drops price even faster. This is not manipulation in the illegal sense. This is how markets are designed to function. The big players are simply smarter about where they place their orders. They know where the stops are. They push price to trigger those stops. They buy back cheaper once the cascade finishes, and they profit from the difference every single time. Today, February 12th, 2026, that is exactly what happened. All those buyers who entered between January 26th and yesterday, all those hopeful investors who thought gold was going back to 5,600 and silver was going back to 120, all those people who placed their stop losses in logical places, they all got stopped out. Every single one of them with tight stops, gone, out of the market. Their positions liquidated, their hopes crushed. And the big players, the institutions, the whales who triggered this move, they are now sitting on profits from selling high and buying back low. They will do it again, and again, and again, until retail traders learn how this game actually works. Now let me tell you something that changed my entire approach to trading. Something that a multimillionaire trader told me years ago when I was struggling. We were in Shanghai. I was having a terrible month. I had been stopped out of position after position. My account was bleeding. I was questioning everything. And this man, who had made more money than I could comprehend at the time, he looked at me and said something I will never forget. He said, "This game is not about making millions at all costs. This game is about doing everything possible to make sure the market does not kick you out. If the market cannot kick you out, the money will come. More money than you ever imagined. But first, you have to survive. You have to stay in the game." Let that sink in. The goal is not to get rich quick. The goal is to not get kicked out. Because if you stay in the game long enough, if you position yourself correctly, if you understand how the big players operate, the money comes naturally. It comes as a byproduct of survival. The people who got stopped out today, they got kicked out. The people who understand what I am teaching you, they stay in. They survive. They will be here when gold hits 6,000. They will be here when silver hits 300. They will capture those moves. The ones who got stopped out today, they will watch from the sidelines, too scared to get back in until it is too late again. So how do you not get kicked out? How do you survive these liquidity grabs? The answer is simple but difficult to execute. Wide stop losses, extremely wide stop losses, so wide that it is almost impossible for the market to reach them. I know what you are thinking, but that is crazy. If my stop is that wide, I could lose so much money. And yes, that is true. But let me ask you a question. What is worse? Having a wide stop that never gets hit, riding through volatility and capturing the eventual move higher, or having a tight stop that gets hit every single time, losing small amounts repeatedly until your account is empty and watching the move happen without you? The math is clear. Death by 1,000 cuts is still death. Every time you get stopped out, you pay commissions, you pay spreads, you pay the emotional cost of being wrong, you pay the opportunity cost of not being in the market when it finally moves. And most importantly, you pay the big players who took the other side of your trade. Let me give you a real example using today's move. Say you bought silver on February 1st at $82. You thought silver is recovering. I want to be positioned for the move to 120. Logical thinking, good analysis, correct long-term view. If you placed a tight stop at $79, about 4% below your entry, you got stopped out today. Silver dropped below 77. Your position is gone. You took a 4% loss. And now silver could rally back to 90, to 100, to 120, and you will not be in it. You were right about the direction. You were right about the analysis. But you still lost money because your stop was too tight. Now imagine instead you placed your stop at $60, a massive 27% below your entry. Crazy wide. Most people would call that reckless. But what happens? Today's drop to 76.95 does not touch your stop. You are still in the position. You are still in the game. Yes, you are showing an unrealized loss right now. Yes, it is uncomfortable. But you have not been kicked out. And when silver eventually goes to 120 to 150 to 200 to 300, you will be there. You will capture that move. The temporary pain of seeing red on your screen will transform into life-changing profits. This is the difference between amateur traders and professionals. Amateurs optimize for comfort. They hate seeing red. They hate being wrong, even temporarily. They place tight stops so they can quickly exit if the trade goes against them. They feel in control, they feel responsible, they feel smart, and they lose money consistently. Professionals optimize for outcome. They accept temporary discomfort as part of the game. They accept that being down 20% temporarily is acceptable if the eventual upside is 200%. They do not let the market kick them out. They position themselves for the big moves, and they make fortunes while amateurs watch from the sidelines. Now let me talk about what this means for gold and silver specifically, because the current setup is important to understand. Gold just dropped from above 5,100 to 4,957, that is about 3%. Silver dropped from above 82 to 76.95, that is about 7%. Silver always moves more dramatically than gold. That is normal. These moves feel significant, they feel scary, they generate headlines and fear. But zoom out. Where is gold in the bigger picture? Gold is still massively higher than it was a year ago. Gold is still in a major bull market. Gold is still being accumulated by central banks worldwide. The drop today does not change any of that. It just transferred wealth from weak hands to strong hands. Silver is in the same situation. Yes, it dropped. Yes, people got stopped out. But the fundamentals have not changed. The supply deficit is still there. The industrial demand is still growing. The delivery crisis is still approaching. Nothing that happened today changed the structural picture. All that changed is who is holding the positions. Let me give you some specific numbers from the data I track daily. Comex registered silver just broke below 100 million ounces for the first time in modern tracking history. Total registered now sits at 98 million ounces after nearly 5 million ounces drained in a single day. March open interest sits at roughly 65,000 contracts. That represents 325 million ounces of paper claims, against 98 million ounces of registered physical silver. The ratio is now 3.3 to 1. For every ounce of real silver available for delivery, there are 3.3 ounces of paper promises. First notice day is February 27th. 2 weeks from now, the squeeze potential is enormous. But today's price action does not reflect any of that. Today's price action was purely about liquidity, about shaking out weak hands, about transferring positions from retail to institutions. The big players know the squeeze is coming. They want to accumulate as much as possible before it happens, and the best way to accumulate is to push price down, trigger stops, and buy from the panicked sellers. Let me tell you about Shanghai because this is critical for timing. The Shanghai Metals Exchange closes Sunday, February 15th through Monday, February 23rd for Chinese New Year. 8 days where the Eastern physical market goes completely dark. Western banks know the Shanghai bid disappears temporarily. They know that during this period there is no Eastern physical buying to absorb selling pressure. Historically, this creates a manipulation window. Expect heavy volatility during this period. Expect attempts to push prices lower. Expect the paper markets to do everything they can while the physical market is closed. This is documented pattern. Check historical price action during past Shanghai closures if you do not believe me. The move today might just be the beginning of this manipulation window. But here is what is different this time. China's silver market was already in record backwardation before the holiday started. The front month contract on Shanghai climbed to record premium over the next active month. That kind of extreme backwardation is driven by genuine shortage. Investment bar demand and solar manufacturing are draining stockpiles faster than they can be replenished. Short sellers are paying deferral fees just to avoid delivery. That is not normal market behavior. That is shortage mechanics, plain and simple. Now let me address the fundamental picture, because this grounds everything. The Silver Institute just released their 2026 outlook, 6th consecutive year of structural deficit confirmed. Forecast deficit stands at 67 million ounces. Investment demand surged 20% to 227 million ounces. That is a 3-year high. India alone is projected to import roughly 220 million ounces. Let me put that in perspective. Global annual mine supply is approximately 820 million ounces. India, one country, is importing 25% of total global mine supply. That level of demand is unprecedented. Industrial demand is projected at roughly 650 million ounces. Mine production is up only 1% to 820 million ounces. Recycling jumped 7%, topping 200 million ounces for the first time since 2012. But even with increased recycling, demand still outpaces supply by 67 million ounces. For the 6th straight year, that is cumulative drain on above-ground inventories. The vaults are emptying. The registered silver is declining. The physical market is tightening. None of that changed because of today's price drop. The fundamentals do not care about daily candles. Let me tell you about something happening at the geopolitical level that most people are not connecting. China's combined holdings of U.S. treasuries, stocks, and bonds have declined to $1.56 trillion. That is near the lowest in 14 years. Excluding Belgium held treasuries, which are widely believed to represent Chinese custodial accounts, total holdings are down to $1.16 trillion. That is the lowest since 2008. Think about what that means. The largest foreign holder of U.S. debt is systematically reducing their dollar exposure. They have been doing this for 14 years. Where does that capital go when it leaves U.S. treasuries? It goes into commodities, it goes into infrastructure, it goes into physical assets, it goes into strategic materials like gold and silver. China is not stupid. They see what is coming, they are positioning accordingly, and now China is urging their banks to begin selling U.S. treasuries. This is accelerating. The decoupling from dollar assets is accelerating, and precious metals are the primary beneficiary. Let me give you another data point that shows the world is changing. Texas just announced they will produce their own gold and silver coins for IRA and 401k use for residents. The initial batch will be commemorative, but larger batches for statewide IRA holdings are coming. Scottsdale Mint is involved in the process. This is the first of many states that will begin issuing their own sound money. Think about the implications. When individual states mint their own coins, and those coins are approved for retirement accounts, you are creating institutional demand infrastructure at the state government level. If Texas succeeds and other states follow, Florida, Wyoming, Montana, you are talking about tens of millions of retirement accounts suddenly having approved access to physical precious metals. That is structural permanent bid from retirement savings rotation. That is demand that did not exist before. And it is coming online just as supply deficits deepen. Now let me address the technical picture because I know many of you are watching indicators. Last video I mentioned we had reclaimed the 150 exponential moving average on the hourly chart. Potential support was forming. Well, as you can see from today's price action, that level has not become support. It failed the test. Price is back below it, which means on paper, structurally, silver could go lower from here. The 150 EMA is now acting as resistance, not support. I am discussing these indicators for short-term traders specifically. This is not a buy signal. This is not financial advice. This is tape reading education. If you are a short-term trader, you should be cautious until that level gets reclaimed with conviction. If you are a long-term investor with wide stops, the technical picture matters less because you are not trying to time every wiggle. You are positioned for the big move. Here is what I want you to understand about the relationship between technical analysis and fundamentals. In the short term, technicals dominate. Price can move against fundamentals for days, weeks, even months. Paper markets can push prices wherever they want temporarily. Stop hunts happen, manipulation happens, volatility happens. But in the long term, fundamentals always win. Always. Without exception. You cannot have 6 consecutive years of supply deficit and have the price stay low forever. You cannot drain registered inventory to 98 million ounces with 325 million ounces of paper claims and not have a reckoning. You cannot have China in record backwardation and not eventually see that reflected in global prices. The short term is noise. The long term is signal. Your job as an investor is to position for the signal while surviving the noise. Let me tell you about the current equilibrium because this is important. Silver rallied from around $63.90 to roughly $93. That is roughly 30% up from the bottom. Then it corrected to current levels around $77. That is roughly 30% down from the high. Both bulls and bears got their validation. Prices coiled between two narratives. Paper traders seeing resistance, physical buyers seeing value. The technical traders are bearish, the fundamental investors are bullish. This is the calm before one side breaks decisively. And based on everything I track, based on the inventory levels, the delivery ratios, the geopolitical shifts, the state-level infrastructure being built, I believe the fundamental side will win. It may take weeks, it may take months, but the direction is clear. Higher, much higher. Now let me be honest about the bearish case because balance matters. March 1st, notice day is 2 weeks away. Contracts can roll to May. Cash settlement can be enforced. The system has more tools than most people realize for avoiding delivery failures. Shanghai closes, creating an 8-day manipulation window. Without Eastern buyers, Western banks can push prices lower temporarily. The 150 EMA just broke. Technicals could deteriorate. Silver could retest lower levels before delivery pressure materializes. Corporate bankruptcies are elevated but not at crisis levels yet. Defaults are high but not catastrophic. The economy could muddle through stagflation without a dramatic breakdown. Paper manipulation has persisted for decades despite recurring physical tightness. The establishment has contained these situations repeatedly. Technical traders watching the EMA break have legitimate reason for caution until the level is reclaimed with conviction. These are all valid points. I am not dismissing them. I am simply saying that the fundamental picture is stronger than the bearish case. Here's what I am watching in the next 2 weeks. February 27th, first notice day for March contracts. March open interest currently at 65,000 contracts, representing 325 million ounces against 98 million registered. Shanghai closes February 15th through 23rd, creating the manipulation window. China is already in record backwardation. The $6 premium between Shanghai spot at $88 and Western spot at $82 continues. India importing 25% of global mine supply. Sixth straight deficit confirmed by the Silver Institute. Comex registered below 100 million for the first time in modern tracking. Watch what happens during Chinese New Year closure. Watch delivery intentions leading to February 27th. Watch whether the 150 EMA gets reclaimed or continues to act as resistance. Watch Shanghai Premium when markets reopen February 24th. Watch the March contract specifically. Does it roll to avoid delivery or does it stand for physical? These are the data points that matter, not the daily candle color, not the fear in the headlines, the actual structural data. Let me tell you why today's drop does not worry me at all, because I have seen this movie before. I have seen it dozens of times. Price drops, fear spikes, headlines scream crisis, retail panics and sells, institutions accumulate, and then price rallies to new highs, while the people who sold at the bottom watch in disbelief. It happens every single time. The specifics change, the timing changes, but the pattern is eternal. Weak hands transfer to strong hands during volatility, then strong hands profit when price eventually moves higher. The only question is which category you fall into. I want to share something personal with you because I think it will help. When I first started trading in Shanghai, I was terrible. Absolutely terrible. I had all the knowledge, I had read all the books, I understood technical analysis and fundamental analysis, but I could not make money consistently. And the reason was simple. I was trading like everyone else. Tight stops, quick exits, trying to be right all the time, trying to avoid any losses. And the market ate me alive. Every single day I would get stopped out of positions that eventually went my direction. Every single week I would watch trades hit my stop loss and then immediately reverse. It was maddening. I felt like the market was specifically targeting me. And in a way, it was. Because I was doing exactly what millions of other retail traders were doing. I was providing liquidity. I was the exit liquidity for the big players. They were making money off my stops. It took me years to understand this. Years of losses, years of frustration. But when I finally got it, when I finally understood how the game actually works, everything changed. I stopped fighting the market. I started positioning myself differently. I widened my stops to levels that seemed insane. I reduced my position sizes to account for the wider stops. And suddenly, I stopped getting kicked out. I started capturing moves I had always believed in, but never profited from. That transformation made me one of the most successful traders in my circle. Not because I got smarter about analysis. My analysis was always good. But because I got smarter about positioning, I stopped being the exit liquidity. I started being the one who accumulates during volatility and profits during expansion. Today, I am here to share that knowledge with you. Because I see so many people making the exact mistakes I made. I see them placing tight stops and getting hunted. I see them panicking on days like today. I see them selling at the bottom and missing the eventual rally. And I want to help them break that pattern. That is why I make these videos. That is why I spend hours analyzing data and explaining what I see. Not to tell you what to do, but to show you how the game works so you can make better decisions for yourself. Let me give you practical guidance for what to do right now. If you are currently in gold or silver positions and you got stopped out today, take a breath. Learn from it. Next time, consider wider stops or no stops at all. Yes, no stops at all is a valid strategy if your position size is appropriate. Many successful traders do not use stops. They use position sizing to manage risk. A small position with no stop can survive any volatility and capture any eventual move. A large position with a tight stop will get hunted and kicked out. Think about which approach serves you better. If you are currently in gold or silver positions and you did not get stopped out today because your stops were wide enough, congratulations, you understand the game. Stay patient. Do not panic. Do not second guess yourself. The fundamentals have not changed. The delivery crisis is still approaching. The supply deficit is still real. Your position will be rewarded if you simply survive. If you are watching from the sidelines and considering entering, today might actually be an opportunity. Price just dropped significantly. Fear is elevated. Weak hands have been flushed. The people who were going to sell have sold. What remains is a cleaner market setup. But if you enter, do so with appropriate position sizing and extremely wide stops or no stops at all. Do not become the next round of exit liquidity. Let me leave you with this thought. Gold will go to 5,600 again. Gold will go to 6,000 and beyond. Silver will go to 120 again. Silver will go to 200 to 300 and beyond. I am absolutely certain of this based on everything I track. The fundamentals demand it. The supply deficits demand it. The monetary debasement demands it. The geopolitical shifts demand it. The question is not if these prices will be reached. The question is whether you will be positioned when they happen. The people who got stopped out today will probably not be positioned. They will be too scared, too burned, too convinced that the market is rigged against them. They will watch from the sidelines as gold and silver rally to new highs. They will say, I knew it was going up, but I got stopped out. That is the tragedy of tight stops. Being right about direction and still losing money. Do not be that person. Learn from today. Understand what actually happened. It was not a crash. It was a liquidity grab. It was not the end of the bull market. It was a transfer of positions from weak hands to strong hands. It was not a reason to panic. It was a lesson in how markets actually work. Now, you know the lesson. What you do with that knowledge is up to you. But remember what that multimillionaire trader told me in Shanghai. This game is not about making millions at all costs. This game is about doing everything possible to make sure the market does not kick you out. If the market cannot kick you out, the money will come. Stay in the game, survive the volatility, position yourself for the big moves, and stop letting tight stops turn you into exit liquidity for the institutions. That is how you win in this market. That is how you build real wealth over time. Not by being right about every wiggle, but by being positioned correctly when the big moves finally come. Drop a comment telling me if today's drop scared you or if you understand now what actually happened. I read every single comment. Share this video with someone who panicked today. They need to see this before they make a decision they will regret. Subscribe for more analysis like this. I will keep tracking every data point, every delivery ratio, every inventory update, and I will be here to walk you through what happens as we approach the March 1st notice day. The next 2 weeks are going to be volatile. The Shanghai closure creates opportunity for manipulation, but the fundamentals are stronger than ever. Stay focused on what matters. Stay in the game. And remember, the goal is not to be right about every move. The goal is to be positioned when the big move finally comes. This is the hidden economy. I will see you in the next one.